Welcome back to the deep dive. If you've been tracking the market mood over the last few weeks, you'll probably agree with what we've seen in our research today.
hmm
The foundation of the economy, it feels steady, but the prevailing sentiment is one of fundamental, widespread caution.
It really is. We're sitting at this fascinating moment where the market is fully expecting a major move, but, it seems like everyone is just waiting
Waiting for what
for
exactly?
some kind of clear external signal before they actually commit capital. And that cautious atmosphere, it's just generating so much signal noise.
Right. So our mission for this deep dive is to cut through all that static.
Exactly. We want to pull out three, let's call them high conviction vectors of change that are going to define the rest of this year and probably the start of the next one.
And what are we looking at?
First, how technology might fundamentally rewire the pricing of risk itself. Second, this massive structural change in consumer behavior, which is really being driven by private labels.
Right.
And finally, how the AI race is transforming big tech. I mean, it's turning it from this high-margin software play into something that looks a lot more like heavy industry.
All right, before we get into that, let's start with a quick snapshot. Our breakfast openers, just to ground us in the week's action.
Yeah, let's do it.
The indices were a really mixed bag.
They were. And that reflects that internal uncertainty we were just talking about.
It really does. I mean, you look at the S&P 500, and it managed to stay essentially flat, just holding steady near, what, 6,704.8.
But then the tech-heavy Nasdaq, which is so sensitive to the whole AI story, it sort of caught its breath. It was down about 0.5%,
Contrast that with the Dow Jones, though. It climbed 0.72%.
which suggests a slight rotation, right? Maybe towards value, or perhaps sectors that are less exposed to all this immediate Fed angst.
But the most revealing signal, if you look outside the big indices, is the defensive positioning.
Oh, absolutely. We've seen gold firming up, and the dollar block has been gaining strength.
And when you see gold and the dollar in demand like that, it tells you investors are quietly, prioritizing safety. Why the rush to rebuild those buffers right now?
Well, it connects directly to two things. First, this persistent uncertainty about the Federal Reserve's next moves. Will they cut? Won't they? And when?
The billion-dollar question.
It always is.
Yeah.
And second, we're in a temporary data blackout period, which leaves traders feeling like they're flying a little bit blind. When conviction is low and information is scarce, liquidity just rushes towards safety.
Which creates that dollar demand. Okay, let's take that uncertainty head on then. Let's look at the market solution proposed in our source material, prediction markets.
Yeah, this is fascinating.
The core question is, can platforms like Kalshi move from being these sort of regulatory curiosities to becoming core market infrastructure?
It's an incredibly compelling proposition. The central issue here is informational efficiency.
What do you mean by that?
Well, think about how we currently price the probability of a major event, like a December Fed rate cut. You have to analyze these really complex futures curves. You have to extrapolate the implied probabilities.
And account for all the opaque positioning of institutional dealers.
Precisely. It's a process that requires, layers and layers of interpretation.
And a lot of very complex math, I'd imagine.
Exactly. And prediction markets they simplify this massively. They offer pure, direct odds.
So the contract is just simple. It's like, will the Fed cut by 25 basis points in December? Yes or no?
That's it. And the trading price of that single contract is the market's consensus probability. These markets are built for information first. They're designed to harvest the wisdom of crowds, and hedging becomes almost a secondary benefit.
That feels like a much cleaner, more immediate feed than what we have now.
It is. We already know that macro info flows through derivatives, right?
Yeah.
Index futures set the tone for equities. Fed funds futures shape policy expectations. Prediction markets feel like the next logical step.
Okay, so if they are so superior in terms of informational clarity, what's holding them back? Why aren't they dominating the space right now?
It's a multifaceted answer, but it mostly boils down to practicality, cost, and, regulation.
The usual suspects.
The usual suspects. They have to close this significant efficiency gap with traditional exchanges. That means costs have to shrink. Bid-ask spreads need to tighten dramatically.
And you need leverage, right?
You need better leverage, and most critically, you need deep, reliable liquidity. A serious investor has to know they can exit a large position smoothly and quickly when new data hits. If they can't,
They'll stick with the futures and options markets every single time.
every single time. But the bigger roadblock, and this was highlighted in the regulatory sources, it seems to be this turf war.
Between the CFTC and the SEC.
Exactly. Over whether these platforms are exchanges, or if they're gambling, or something else entirely. Until that regulatory environment stabilizes, they just can't achieve the necessary scale.
So that's the ultimate constraint.
That is, until there's regulatory certainty, the volume caps are lifted, they can't compete on size.
Mm-hmm.
But, and this is the key point, if they overcome those hurdles, they won't replace the NYSE or Nasdaq.
Their function is different.
It's totally different. They'll just change the information flow hierarchy. Macro pricing could start with these cleaner, simpler prediction contracts, which would then ripple outward to influence the pricing of futures and bonds. They could become the first screen that analysts check.
That shift from complex derivatives to clean probabilities is a major development to track. Okay, so let's switch gears pretty dramatically here.
Let's do it.
From the abstract world of risk pricing to the very real and immediate cautiousness of the American consumer. It feels like that market uncertainty is translating directly into tightening purse strings.
That's the perfect transition, because the market caution we were talking about isn't abstract at all. You could see it in every major retailer's earnings report.
Caution is louder than confidence.
Absolutely louder. And that's even among higher-income households.
So give us some of the details the sources emphasized. What are we seeing on the ground?
We're seeing a unified message across the board. Take Target, for example. They've said publicly they're cutting prices aggressively just to protect customer traffic.
And they're accepting a hit to their profit margins to do it.
They are. Then you have Home Depot reporting that homeowners are deferring major expensive renovation projects. Big-ticket items. People are choosing maintenance over massive capital outlay.
And Walmart's growth seems to tell the most specific story.
It really does. Their recent growth is being driven almost entirely by value-seeking upper-income households. We're talking people earning six figures or more, looking for ways to save money on necessities.
So the wealthy consumers who carry discretionary spending through 2024 are now becoming value-conscious.
Exactly. It's not about poverty, it's about perceived value in an inflationary world. And this trade-down wave is directly benefiting deep discount apparel specialists. Your Gap, Ross, TJX.
Right. Because consumers are looking for quality fashion at heavily reduced prices.
And that brings us to the core of this whole consumer shift. The rise of the private label.
Our sources are calling this America's new inflation hack. It kind of mirrors what we've seen for years in Europe with stores like Aldi and Lidl.
This is a profound structural shift. Private labels are no longer associated with low quality or, desperation. They are building genuine loyalty.
Look at Costco's house brands, right? They're now being described as economic moat products.
They are. They aren't just substitutes anymore. The quality and price combination is now a reason for upper-income consumers to subscribe to Costco.
And the gold standard, of course, is Trader Joe's. They prove that store brands can create a cult status.
That synthesis is so crucial for investors. Consumers are trading down on price, but they are absolutely not trading down on experience or perceived quality.
And that creates enormous pressure on the traditional legacy CPG consumer packaged goods brands.
Huge pressure. We're talking about the companies that rely on branding for every dollar of profit. Your packaged snack makers, frozen food processors, all of them. The retailer captures higher margins with their house brands, and it just squeezes the CPG players in the middle.
That shift in power from the CPG brand to the retailer, that is going to reshape grocery aisles for a decade.
No question.
Okay, let's move now to our third major structural change. What our sources are calling tech's industrial revolution. The AI race is forcing big tech to act less like software companies and more like
Heavy industry.
Yeah,
This is really the death of the asset-light tech dream. The scale of the capital expenditure, the CapEx cycles required to build this AI infrastructure, it's unprecedented.
Give us the scale. I mean, what kind of money are we actually talking about here?
We're talking about numbers that would make traditional industrial CEOs blush. Amazon is committing a staggering $50 billion.
$50 billion.
$50 billion for government-grade AI infrastructure. Microsoft's famed cash pile, which was long considered this impenetrable defense, it's shrinking fast because of GPU purchases and data center buildouts.
And the competitive pressure is forcing diversification too, which just increases the complexity and the cost.
Absolutely. Meta, for instance, is actively exploring Alphabet's internal chips just to diversify away from total reliance on NVIDIA. And to fund all of this,
They're going back to the bond market.
they're back in the bond market. Meta and Amazon are borrowing significant sums of money to build what is essentially physical, heavy industrial infrastructure.
That emphasis on physical is really key here. This isn't just code or cloud services anymore.
Not at all. This build-out requires massive amounts of concrete, cooling, energy, real estate, high-voltage turbines. The old era of light software margins is over. This is an energy and materials play now.
And this is where the new winners emerge.
This is exactly where they emerge. The massive density required by AI clusters is straining local utilities to the breaking point. And this has forced big tech to adopt what we're calling BYOP, bring your own power architectures.
Okay, can you just elaborate on that? What does BYOP actually mean for a data center?
It means they can't just rely on plugging into the public grid anymore.
Yeah.
BYOP involves building proprietary power solutions right next to or even inside the data center. We're talking dedicated natural gas turbines, large-scale battery storage, even microgrids.
So they're effectively becoming their own power utility.
They are, and consequently, the beneficiaries are shifting. It's not just the data center landlords anymore. Now it's the power suppliers, engine makers, industrial equipment manufacturers, fuel cell players,
Yeah.
anyone who can support this massive power-hungry build-out.
The AI race has become an energy race. That is a fundamental connection. Okay, let's wrap up our deep dive with a quick look at two sectors undergoing equally profound reshaping. First, the incredible momentum around GLP-1 drugs.
Yeah, Novo Nordisk's new obesity drug, amycretin, is making huge waves.
Why is this one so significant?
It's just truly remarkable. It combines the familiar GLP-1 mechanism, which manages appetite, with another one called amylin, and it delivered a 14.5% weight loss in early trials.
So this positions Novo Nordisk not just in a single product boom, but as a leader in a multi-drug, multi-year pipeline strategy.
That's the key. And if you're wondering how it compares to the current leaders, like Zepbound or Wegovy, well, Zepbound uses two mechanisms, GLP-1 and GIP. Amycretin's inclusion of amylin adds a third dimension.
What does that third dimension do?
It specifically targets energy expenditure and fat metabolism. So it could potentially lead to even greater efficacy and, more importantly, address weight maintenance better than the current drugs. This is becoming a foundational healthcare category.
And the economic consequence of this goes way beyond pharma.
Oh, it absolutely does. The widespread adoption of these drugs is going to reshape huge chunks of the economy, the grocery sector, health insurance models, even discretionary retail as consumers change their spending habits. It's a slow-motion societal transformation.
All right, finally, let's quickly look at crypto. Our sources note that Bitcoin is behaving exactly like a macro asset again. It's range-bound near $86,000. But the underlying data is what's really interesting.
That's the key takeaway. The on-chain data shows clear caution. We're seeing negative funding rates, which is a defensive indicator. Options traders are buying significant downside protection. ETF outflows are picking up.
And the conclusion is what?
The conclusion is that Bitcoin is no longer trading purely on its own internal momentum. It's now highly sensitive to major external macro data. The Fed's decisions, jobs reports, the direction of real yields, it's behaving like a high beta tech stock.
Okay, so let's synthesize all of these signals. We've got three major vectors of change here.
Right.
The consumer's caution is leading to private label reliance. AI demand is transforming tech into heavy industry. And prediction markets are trying to provide the cleaner odds everyone is craving.
The common thread linking all of these is this urgent need for efficiency and capacity in what is really a resource-constrained world.
And if you had to point to one thing for our listeners to watch next, the most pressing area, what would it be?
It would be the direct consequence of that AI CapEx shift we talked about, the stress on utility capacity.
The BYOP architectures?
Exactly. We know big tech needs to bring their own power. The big question now is how power markets and utility capacity will react as this AI build-out exposes massive bottlenecks in energy generation and transmission.
So this is going to expose critical vulnerabilities.
And create new winners and losers across the entire industrial landscape, from the copper market all the way to municipal planning commissions. If you want to see the next major market signal, pay extremely close attention to the utility sector.
It's a fascinating thought. It really reminds us that to understand market moves, you have to look beneath the headlines. You have to identify these underlying industrial and behavioral shifts.
That's what it's all about.
Which is exactly what we set out to do. Thanks for joining us for this deep dive into the source material. We'll see you next time.